zur neuen Ausgabe SI Talk und ich habe es endlich wieder geschafft. Ich habe Mogo vor das Mikrofon bekommen. Ich bin Aktionär, also Konflikt of Interest. Sie wissen ja, das ist ein Fintech und zwar ein Fintech, das ich extrem spannend finde. Und meines Erachtens haben sie auch die Zahlen jetzt deutlich verbessert, auch wenn es noch nicht so ausschaut. Aber ich finde die Company nach wie vor sensationell und hat auch in den letzten Wochen einen sehr guten Run gehabt, ist gut 40% gestiegen. Ich glaube, da ist noch viel mehr drinnen. Dave, thank you to have time for this interview. And I said in my German introduction, first I have a conflict of interest, I'm shareholder. Second, I think fintech was a great, not bubble is a wrong word, but this was a buzzword 2-3 years ago, and it's now, especially here in Vancouver, is going a little bit down. It's a little bit, cannabis was more in favor. The last,
it was, but now
nobody talks
about
it. It's gone. But you're doing, I think, for my feeling, a fantastic job in the last 2-3 years. So the growth rate is unbelievable, still over 30-40%, depends on which numbers you look. And you do a very interesting deal this spring, I think it was this spring, where you take over, or you get taken over by...
we did it. Essentially, it was a merger.
It was a merger.
That's right,
so you're coming up also then with some asset.
That's
some also interesting companies.
Yeah.
But maybe you can fill us in what you're doing.
Sure.
The last, I think I do an interview with your brother in January. So what's happened since January?
Right. Okay, well, let's talk about that merger, because that was an important milestone since then. And essentially, this was a company that had some cash on their balance sheet and some high-quality investments that were really kind of monetizable investments over the next kind of couple of years. So the main shareholder of that company was also a big shareholder of Mogo, so that's ultimately how it kind of started. And the decision was just made, well, it's actually better to combine, because that really wasn't an operating business. They only had a few employees. And the way to look at it from our perspective is it was really just a creative form of financing. It was another financing, right? So we got close to $10 million in cash, and we also got just over $20 million in what we consider highly monetizable assets that our plan is to monetize those over the next 12 and 24 months, right? And, the effective rate at which that financing was done based on the value of those assets was very effective as well, very positive. So it ended up to be a what we consider a very positive financing, and ultimately that just gives us more room to continue to focus on our growth.
What I was in the beginning, I was a little bit how this looks like. Then I saw this financing opportunity or something. Was really a little bit interesting, or maybe it was also a relation to them. We saw after the share price coming down after the merger a few times. Is it possible that some shareholders from the merger company selling into the market?
I mean, it's possible because our stock actually had some more liquidity than theirs. So one of the issues would have been for some of those shareholders, they were in a fairly illiquid stock. Once the merger happened and they get ultimately the new shares in Mogo, there's some more liquidity. So it could very well be that someone would just say, hey, I just want to use this as an opportunity to liquidate. But obviously you've seen the stock recently in that, but generally, it also just shows you the vote of confidence from basically our single largest shareholder, who is also a large shareholder of that company. He's essentially saying, hey, as the largest shareholder, I definitely believe that I'm way better off having those shares turned into Mogo shares, and what the long-term appreciation opportunity is there. And obviously that gives us the capital that we need to essentially continue to grow and ultimately continue to move towards profitability. So we think we've got enough cash to continue to now, between the cash and those assets, to execute on our strategy.
I saw, when you look also at your presentation, I saw a big disconnect between what you monetize a member and what the banks, for example, monetize. how you will catch up.
Right.
So you coming up to better number.
So I mean, we show that as an example, which just shows, I think, highlights the opportunity, right, that we continue to be focused on, which is, the example we show is essentially there's banks in Canada, but there's credit unions, and credit unions are a lot smaller, but they have essentially they're the same model as a bank. They're just a smaller non-for-profit business, and as an example, we're showing the average revenue per member of a credit union is essentially, in the example we gave, $1,300 a year in revenue. Now, the reason they have that revenue is they have this long-established clientele that has been with them for a while, and they have a good share of that customer's financial wallet. So there you have their mortgage, their credit card, their investments, all of these things, and that's what ultimately drives revenue. And that's really the path that we're on. Our path is, it would be like if you started a bank today, like when ING Direct started in Canada. Initially, they only offered a savings account. Well, you really, in a savings account, you can only do so much revenue if you're only offering a savings account. Technically, you're actually not really doing revenue because you're actually paying out. So you're bringing a deposit in, right, and you're paying out. So until you can start to offer those other products and then over time get more and more of that customer's financial wallet, that's the revenue opportunity. So we essentially were showcasing that. As is an example, Meridian Credit Union, large credit union in Ontario, 275,000 members, and they're essentially doing over $500 million a year in revenue off of 275,000 members. Today we have 900,000 members, which is larger than any credit union in Canada, and we're at essentially a $65 million a year revenue run rate business, right? So, but that is only because we have a small share of our current customers' financial wallet. Many of our members today are signing up and they start with one product like free credit score, where there's technically no direct revenue attached to it, and it's only over time as they start attaching to other products, which also ties into us launching these other products. So we still don't have that full spectrum offering. We're working on launching Mogo Wealth as an example, right? And the wealth industry in Canada, it's over $4 trillion in wealth in Canada, expected to grow to $7 trillion in the next 10 years. RBC, the largest, is managing just over $1 trillion, right? Obviously, there's a lot of revenue driven from managing that wealth. And because we are primarily focused on millennials and everybody, this is where, increasingly things are going, especially on the wealth side. There's a lot of these old school wealth companies out there that they don't really have a mobile first digital platform. They're still onboarding people and dealing with people in a very old school way. Right? Whether it's face-to-face, no mobile app, right? Well, the next generation, both millennials and Gen Z, they want to be able to tap into their phone and access it, right? And so the view there is as those millennials start to, progress in their jobs, get bigger incomes, buy a home, right? And then start saving and investing and building wealth, and also inheritance. That inheritance continues to flow down too. Really, this is where we're positioned long term to, as that credit union customer matures. What's happening at credit unions literally is they are typically older credit unions, branch-based business, relationship-based business. Their clientele is a lot older, like 60, 70, and 80. Like my in-laws, they're in their 80s. They have all of their assets at a credit union. But when they pass on, those assets are going out of the credit union and going into essentially where does the next person bank, right? So that's where we're really positioned. So you think long term, right? Over the next 5 to 10 years, our strategy has always been it's all about best-in-class mobile experience and best-in-class product offering. That's really what's going to win. Millennials and Gen Z will increasingly say, I need a best-in-class mobile-first experience, and I absolutely need and demand that, but I also want best-in-class products. I am not prepared to take a 1% interest on my savings account if there's such a thing as a 2.5% interest rate out there in the market. And i.e., I find out I'm getting less than half of what I could get somewhere else, which is actually what's happening in Canada right now. But as this digital transformation continues to happen, that's no longer the case. So that's really how we're kind of positioning ourselves.
So that's mean we must look a little bit on your product pipeline.
Yeah, exactly.
So how does it look like?
Yeah, so we're continuing to, and we had announced that we're going to be launching the wealth product. This is again, we are not a bank, right? We are we are a fintech. We are licensed and regulated in all the provinces we're in for the products we offer. But our strategy really is to partner. And so, for example, on the wealth side, we're still working to essentially establish who that partner is going to be for things like our high interest rate savings account and on the wealth side, right? And it takes a while to find that right partner, right? Both what our criteria is and also the partners. And that, so we're continuing to have those conversations, and things are going well. So we do expect that at some point in the near future, we're going to announce something there.
Can you qualify what's near future mean?
Well, I would obviously, at the very least, I'd be very disappointed if within the next 6 to 12 months we haven't announced some important partnerships there, right? So that I would say that is definitely the expectation. And essentially what that's going to allow us to do is, and that's what we're doing, we're essentially trying to curate those best-in-class products. So who offers the highest savings account out there? And what are the best wealth products? So what you're starting to see on the wealth side, which is, I'm sure you saw that just happened yesterday or the day before in the U.S., Charles Schwab announced they're going to zero commission. And there's a perfect example of the disruption that is being driven from these fintechs. So in the U.S., obviously one of the biggest markets in the world, Robinhood was essentially the first, big fintech out there in the stock trading that essentially started to disrupt on the pricing. And a lot of the bigger players said, oh, we're never going to match that, everything else. And all of a sudden, Charles Schwab, which is really the biggest in terms of assets they've got, they went free. And literally that same day, TD Ameritrade said, we have to go free too. So, and that's what's happening. That's driven from the fintechs. Now, in the meantime, Robinhood acquired 6 million customers. They got to 6 million customers before it was a meaningful enough impact in which then now the bigger players say, okay, guys, we can no longer ignore this, right? So the opportunity for Mogo is the banks aren't going to go out today and say, oh, we're going to match Mogo on the rates because we just aren't having that big of an impact. But if it continues to look like they're getting more and more traction and a meaningful level of traction where all of a sudden, what, are we going to lose all our customers? That's when you're going to most likely see some of the big players say, hey, we have to get more competitive, right?
But the other thing is you're a stock-listed company, so for them it's maybe easier to acquire you.
Well, and this is just it. So obviously there's no question that is absolutely a potential path here. And you look in the U.S., for example, the biggest banks are each spending $10 billion a year on technology, right? Up here in Canada, the big banks are spending between about $3 and $4 billion, right, a year. So when you look at that's how much they're spending, an acquisition within that $3 to $4 billion a year spend, obviously is relatively small. So generally, it's the view is until somebody is a meaningful enough player where it's like they don't mind. They probably wouldn't mind buying a company at $1 billion. I mean, just like Scotia bought ING Direct. We've talked about that one before. Scotia Bank bought ING Direct in Canada. ING Direct came in here, launched first in Canada. It was the first market they launched. They built it up to 1.9 million customers, $40 billion in assets. Sold to Scotia Bank about 5 years ago now for $3.5 billion, right? And that's a similar opportunity that we believe we have, right? We absolutely believe that we're on a very similar path to what ING was doing, but in a more mobile, digital way than what they did. And obviously right now we're getting close to 1 million members, right? So that's obviously meaningful. We are still signing up around 20,000 members a month, so that's almost 250,000 a year. To put that in perspective, RBC, Canada's largest bank, said that this year they're going to acquire about 300,000 customers. So just in terms of how many people we're signing up annually, we're getting very close to what the largest bank in Canada is signing up, right? The number 6 bank in Canada is National Bank, and they have just under 2 million customers, right? So, we're starting to get up there. Now it's just a question of how much of that customer's financial wallet do we get, right?
Okay. What other product you work beside the wealth?
Excuse me. So we're one of the big initiatives, and you looked at the recent quarterly review there. One of the big initiatives we've got is, and it's not just about product. At the end of the day, this is also, it's probably more about experience. So really our view is most banking products essentially become commodities, right? So you go to any of the big banks, almost all the big banks have essentially the same product. They each have a checking account, they each have a savings account, they have a wealth product, and you'd be hard-pressed as a consumer to go to any one of those and say, oh, here, they're totally different. They're almost all the same. Same fees, everything. Even their experience is very similar, right? What we believe the real differentiator is, and this is what I believe absolutely is the future, the reason why banking is going away, and the future of banking is going to evolve to what I believe is what we're calling financial health, financial wellness, And that's all about not only finding those products, but tying them together in an experience. And that's what our mission says behind you, is make it simple and engaging for consumers to get financially fit, right? And so there's, today in banking, there's a whole bunch of products that they offer. And if you knew what to do and which products to do and how to use it, you could be financially healthy. But they don't walk you through that. They don't make it easy to say, do 1, 2, 3, 4, and you're going to be financially healthy. Instead, what they do is they say, hey, get a credit card, do this, and you got to figure this all out. You get a credit card, you start overspending. That's one of the reasons why in Canada, first of all, the recent surveys show across all demographics, 56% of consumers say financial stress is by far their number one stressor, more than health, job, and relationships combined. Okay,
wow.
And for millennials, it's 76%. Right, so when you look at you do a survey and say what are the top stressors in your life, the 4 common elements of human happiness are health, relationships, meaningful work, and financial freedom. And financial freedom is by far the biggest stressor out there. And the reason that is even though everybody's predominantly relied on banks, they've actually made it so that their products are highly profitable for them, but not for the consumer, which is why in Canada, 9 years in a row, getting out of debt was the number one goal of Canadians, 9 years in a row. So the challenge right now for millennials, as an example, as a cohort, is a lot of them have debt, and the number one driver of debt is credit cards.
Yeah.
Right? And then what happens is you're now 30 and heading into your 40s, and you've got this credit card debt, and you're like, hey, wait a minute, if I don't get on paying this down, I'll never get to saving and investing, and I'll never be able to retire. Which is also why 45% of Canadians say, I'll never have enough money to retire. So this is the problem. That is the problem, and this is what we're trying to solve it. And so this is about, and we've laid it out in our recent deck, we're essentially creating this new experience we call Money Up, which essentially, it's all based on the psychology of goal setting and performance, and it specifically is around, you set a goal, what is your money goal? And everybody should have a money goal. The more you have a goal, the more likely you are to achieve it. And then we walk you through, here's the exact 4 habits you need to master in order to be financially healthy. That means paying down debt and saving and investing. And we have content that walks you through all of that. And then we have a daily process that helps to kind of keep you on top of that. And then we actually give you the tools. So we don't just say, hey, here's a card, here's a wealth product. We say you need to monitor and protect yourself. You need to monitor your credit score and protect yourself against identity fraud. If you don't have a good credit score, you won't qualify for low rate loans, and that can affect your level of financial health. You then need to control your spending. To the degree that you control your spending is the degree that you avoid getting into debt in the first place. And only by controlling your spending will you have the money left over towards saving and investing. And then you need to save and invest wisely. All investing is not equal, right? And generally, and the stats have proven this out, I mean, investing in general is a racket. There's a whole bunch of things out there that people are paying a lot of money for. One of the examples we used just at a presentation in the office, we showed that if you invested, as an investor, you put $10,000 a year, invested it in essentially the S&P 500 for 40 years, okay? $10,000 a year for 40 years, and you did that through a mutual fund that the bank typically recommends, you'd end up with $1.5 million. If instead you invested it through a low-cost ETF, you'd end up with $2.5 million, an additional $1 million, right? Those are the things that the bank's not telling you about, right? And that's what we're actually building into the experience.
Understandable why they don't tell it.
Exactly. But you can imagine that's the kind of impact that it has on the level. It's a meaningful impact, right? And so that's what we're focused on, is not just the products, but an experience that actually makes it easy for somebody to figure out, here's exactly what I need to do, and to get smart around this so that I know with confidence what to do. The stats today are 82% of millennials are not confident in their investment strategy. So even if you have money to invest, if you're not confident, you don't take action, which is why sometimes people put money into a savings account and they're earning very little because they're fearful of where do I put it? And then they go and hire maybe they go to the bank, and the bank says, oh, put it into a mutual fund, right? And they go, well, I guess they know better than I do. They put in a mutual fund. They still don't know. Or they hire a financial advisor. Financial advisor charges 1%. That 1% fee adds up, right? And a lot of times they're not impartial. They obviously have certain products that they get more money on than others, right? And so that obviously influences as well. So that's what we're focused on, is really, again, making it simple, making it easy, empowering consumers with the knowledge they need to basically be smart around their finances and to know what to do.
Wow. Dave, thank you for the update, and I must really say, from this standpoint, I never look at,
Right.
But it makes absolutely sense, and it always shows up how different Europe is.
Yeah, right.
Then, for example, on our accounts, you don't get interest. And we are happy when we have only 0. It's starting now.
Now you're getting negative, right?
Negative, yeah.
No, I know.
You must pay when you store money.
I mean, it's hard to wrap your head around that, right? It's
So
hard to
this
wrap-
is a total different thing.
Is there debt? Is there a lot of debt for consumers in like Germany and that?
Yes and no, but for other thing, we have not this credit card problem.
Yeah.
Then our credit card is always charged against your account on the end of the month.
Yeah, so it's automatically paid off, you mean? Yeah.
So we have no,
Got
on
it.
the credit card, we have
Right.
no debt.
Interesting.
So,
Yeah.
and that's totally different
Whereas
too.
in Canada, there's 11 million Canadians. There's about 37 million Canadians, right? And obviously that includes people that are underage Canada can afford to have a credit card. 11 million Canadians carry credit card debt, right?
Unbelievable.
And most of that debt, here's the other thing that just shows you how challenging it is to and why it's so important to be in control of your finances. A survey came out the other day that said, in Canada, on average, it takes a millennial 13 years to save for a down payment for a home. In Toronto, it's 21 years. In Vancouver, 29 years. Because, so think about that. 29 years you have to save just to afford the down payment of a home. So if you're not, and if you're already starting out in debt, you got to first pay off the debt before you even start saving and investing. So even if you're like, by the time you're like 25 and like, oh, I'm in debt, I got to start thinking about buying a house, and I got 20 years to save. What am I, 45, 50 before I can buy a house? Right?
Unbelievable. Puh, ja. War ein großartiges Update. Man sieht da, die letzte Diskussion war eben sehr stark darum, wie stark sich eigentlich auch Europa mit Kanada unterscheidet. Aber es ist extrem spannend. Also alleine die Millennials haben, ihre größte Angst ist finanzielle Freiheit. Also nicht, ob sie einen guten Job haben, ob die Partnerschaft gut ist und so weiter, sondern die finanzielle Freiheit. Und einer Sicht der Dinge ist es so, ein Produkt zu haben, um ihnen die Möglichkeit einer finanziellen Freiheit zu geben. Quasi eine Bank gibt ja nicht die Anleitung, wie sie finanziell frei werden können, und das ist ein Anliegen. Einfachstes Beispiel, Credit Card. Kreditkarten, die haben wirklich Schulden auf der Kreditkarte und entscheiden am Monatsende, was zahlen sie zurück, was nicht. 11 Millionen Leute von denen haben Schulden auf der Kreditkarte und die zahlen dort Zinsen, das ist unglaublich. Und ihr Ziel ist es, die sozusagen zu entschulden. Wie kommen die drauf an, dass sie ihre Kosten auch unter Kontrolle haben müssen? Das heißt, ein Tool ist eigentlich, eine App ist eigentlich darum, die Leute zu erziehen im Bereich der finanziellen Freiheit. War eigentlich eine gute Idee auch bei uns, weil ich glaube, dass das bei einigen uns ganz gut tun würde, einigen Leuten, wie man Kosten unter Kontrolle hat, damit man nicht zu viel Geld ausgibt, dass man am Ende des Tages auch noch was da ist zum Investieren, damit man dann, wenn man in der Pension ist, auch noch viel auch Geld hat zum Leben. Das ist in Kanada sicher noch schärfer aus wie bei uns, weil ja wir zumindest ein gewisses Pensionssystem haben, was teilweise hier ja nicht der Fall ist. Aber kommen wir zurück zu dem, warum habe ich auch gefragt, warum ist der Unterschied so groß zwischen dem, was Sie erzielen und was eigentlich die Banken so erzielen? Das liegt ganz einfach daran, weil sie noch zu wenig Produkte haben. Und es dauert einfach so Zeit, bis dass wir die Produkte auf dem Markt haben. Einer der wichtigsten Produkte ist sicher das Mogo Health. Wenn das dementsprechend rauskommt, ich habe gesagt, ja, wann können wir das erwarten? Er sagt, in den nächsten 6 bis 12 Monaten wäre er sehr enttäuscht, wenn das Produkt nicht da ist. Aber das Produkt muss natürlich gut gewählt sein, wenn Sie wollen nicht nur das beste Handling haben, die beste Haptik sozusagen, sondern Sie wollen auch das beste Produkt auch haben. Und um das geht es nämlich, dass die Leute so zufrieden sind mit ihrem Produkt, dass sie dann sagen, okay, dort gehe ich hin und dort werde ich auch Kunde und mache dort meine ganze finanzielle Vorsorge drüber. Und ich glaube, dass die da auf einem sehr, sehr guten Weg sind. Mir hat das extrem super gefunden, wie er das da erklärt hat, finde ich echt spannend. In der Zwischenzeit haben sie ein Merger gemacht im Frühjahr. Das war vor allem darum, eine andere Form der Finanzierung. Sie haben jetzt ein Portfolio an Beteiligungen, an Fintech-Beteiligungen oder Software-Beteiligungen, die sie jetzt dann abverkaufen wollen. Die Company hat 10 Millionen Cash gehabt. Von daher sind sie jetzt natürlich auch finanziell relativ frei, um diese ganzen Produkte auch in den Markt reinzudrücken. Ich bin nach wie vor ein überzeugter Mogo-Aktionär und werde es auch in Zukunft sein. Nur eines weiß ich auch, sollte die Aktie nur mehr auf $3 oder sowas runterkommen, muss ich meine Position aufstocken. Ja, das war's vom Mogo aus Oktober 2019, Vancouver. Tschüss und Baba. Thank you.
Ja, danke.